getting a little bit of a lift today. 30 minutes until the start of this orphan trading day. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, muted moves, futures fluctuate, but it looks like they're on their way up as investors prepare for a very unbusy triple witching event that could fuel more volatility. A $1 trillion pitch. SoftBank founder Masayoshi Son pitches TSMC for an AI mega hub in Arizona where American workers can build robots. And too big to ignore, some on Wall Street are making the case that Broadcom should be considered part of the Magnificent Seven, which would, of course, make it 8.
Right, you add 1 to 7, it becomes 8. We're going to talk about all of that and more, but let's talk about GMS absolutely surging this morning as the building materials giant finds itself in a bidding war. Both Home Depot and QXO have reportedly made offers to GMS, which is currently valued at $3 billion. We don't know the value of the Home Depot bid at this moment, Matt Miller, but you can see traders bidding up the shares in a big way.
Right, Home Depot is a lot bigger than
pretty
QXO.
Big.
Car buyers are turning to the secondary market. CarMax used car sales jumped 9% year over year, and earnings per share beat estimates in a sign that demand is climbing as a result. The shares are up 9%. Let's kick it off with Detroit Bureau Chief David Welch joining us on this story. So I've long waited, David, or I'd say for a few months, to see used car sales really take off because new car sales are becoming so expensive. And now the inventory you're getting on dealer lots now is that inventory that's finally affected by tariffs, right?
That's right. Look, you're just starting to see new car prices rise out there because of tariffs. Some companies, GM is one of them, they've said that they don't want to put price increases in there, but other companies have, and they tend to be kind of sneaky price increases, or dealers just aren't as negotiating as much because inventory is tight, or you're seeing some rebates and other spiffs like that go away. That has a knock-on effect to the used car market. When people see their monthly payment higher when they're over in the new showroom, they say, hey, what do you have in the used lot? And you're starting to see that take effect now. What jumped out to be about CarMax, too, is, sales were up 9%, but gross profits for the used vehicle business were up 12%. So that tells me they're also getting better pricing over there on used vehicles. So, I think you're seeing prices start to tick up here because, hey, supply and demand happens, and the tariffs kind of, there's a wide ripple effect there from what's going on.
Yeah, David, let's stick on pricing a little bit more because not only did they not put through price increases, but you saw the average selling prices of used and wholesale vehicles fall about 1.5% and 1.7% respectively. So prices actually coming down here, CarMax making up for it in volume. But talk to us about sort of the daisy chain here. If you have new cars prices going higher, how long does it typically take to translate through into the used vehicle lots?
It can be months, but it does happen pretty quickly. I mean, it's just not, you can't have one without the other typically. And it's because of that shopping effect, right? So dealers start to get a little bit better pricing on the new car lot, and consumers react to it. The other thing you're going to see, I think, is, according to Alex Partners and some other forecasters out there, new car sales this year are supposed to dip in the second half as we see these price increases. And if people do need cars, then they're going to go look on the used side of the house. And so look, we're in June. I think you'll see used car prices start to take a hit, assuming the new car price increases go through, probably by like September is when I think you see it start to hit.
All right, so buy your used cars now. David, great to speak with you. That is Bloomberg Detroit Bureau Chief David Welch. Now, another company that was out with earnings this morning was Darden Restaurants. It's the owner of Olive Garden and Longhorn Steakhouse. It raised and posted earnings in line with expectations. It raised forecasts. It also authorized a $1 billion new share buyback program. Here with more is Bloomberg North America earnings specialist Rachel Phua. Rachel, great to have you on set. This is an interesting one because you see shares up 5.5% right now. I checked that and thought, oh, well, maybe the stock was getting crushed. No, this company is up 21% year to date, which is hard to do. So tell us what is going so right over at Darden.
So I think you can see the good results, particularly with Olive Garden and Long Hong Steakhouse. Olive Garden, which is obviously their biggest chain, about nearly half of their sales. You know, we see great promotions over the quarter. They had a buy one, get one free entree, which I think, which they said like helped to drive strong demand. They had great sales over Mother's Day. Now they have a $6 entree. So all these promotions are driving customers to Olive Garden. I think we also see that they also launched kind of like their deliveries with Uber like this quarter, and you know that's done well too, and that's kind of helped to push up their sales. I think in general too, you just see like in the casual dining space, you know, consumers are seeing that these brands are giving more value than fast food, which has kind of like increased their prices over the years. So you come to these casual dining restaurants, they give better quality food, they give slightly better portions, and so consumers are going there. I know Olive Garden, Long Hong Steakhouse, they also tend to draw more middle income and higher income consumers, which have been kind of more resilient during this economy. So yeah, I think that's been helping their sales.
And their stock, as Katie points out, has been doing well. Even though we have fears about the consumer, in this area at least, it looks like the consumer is still spending, and that's been encouraging investors to keep piling into this stock.
Yeah, definitely. And you know, I think a lot of analysts also kind of see that their guidance for the next for fiscal 26 is actually pretty conservative. So maybe we can expect them to keep outperforming what the expectations are.
And let's not underappreciate the $1 billion buyback either. So a lot of rewards coming to shareholders here. And maybe the company's saying, we actually think the stock is too low. We're going to buy it back right now. Yeah,
19 buys out of 32 analysts covering the stock. Only one sell. I'm talking about Darden here. Rachel Phua, great to have you with us for this. Let's get to GMS, because those shares are taking off as Home Depot makes an offer for a company that QXO has already bid for. It looks like the Wall Street Journal saying that Home Depot has made an offer to buy building materials firm GMS, potentially setting off a bidding war with QXO, which made a $5 billion offer for GMS earlier this week. So just exactly what I said. In a statement, the spokesperson for QXO told Bloomberg that $5 billion is the full offer. So this is it. For more, we're joined by Drew Redding, home building analyst for Bloomberg Intelligence. Drew, what do we know, I guess, about the Home Depot offer? Is it bound to be better?
So we don't know a whole lot. We don't know if, when, or at what price an offer was made to purchase GMS. So, you know, right now it's just speculation. As you mentioned, QXO said this is at the high end of their valuation range, and they have been pretty disciplined. So we don't know how much higher they would be willing to go. We certainly know Home Depot has deep pockets, and, you know, GMS, while this certainly aligns with Home Depot's longer term vision, which is to expand their market share among professional contractors.
Yeah, well, let's talk a little bit more about that, because it is interesting. You think about Home Depot, what their strategy could be here, why something like GMS would fit into the portfolio. I'm sure a lot of folks watching right now weren't necessarily aware of exactly what GMS does prior to this morning.
Or QXO.
Or QXO, that's for sure. But give us a little bit more detail on GMS and why it's such a hot asset right now.
Sure. So GMS is a distributor of wallboard, ceilings, steel frame, and then complementary products. I think the building products distribution space in general has gotten a little more interesting. It's certainly a highly fragmented market, and you have a player like QXO who recently entered the market, and their goal is to consolidate the industry. So they're going out and they're putting money to work for some of the biggest companies in the space. From Home Depot's perspective, as I mentioned, their long-term strategy and vision is to expand among professional contractors, but what they really want to do is grow within the complex project market, which they see as a $200 billion untapped market. And that's pros who are going out and making bigger purchases for large-scale renovations. And Home Depot wants to be kind of the one-stop shop where they can consolidate all the vendors that a contractor has to use, whether it's wallboard or roofing or windows or doors. They want to be that one-stop shop to consolidate the industry themselves.
All right, Drew, really appreciate the download here. We'll see how this shapes up when it comes to this bid. That is Drew Redding from Bloomberg Intelligence. Meanwhile, we take a check on futures on this orphan trading day, as Matt called it. You can see S&P 500 futures up about 0.4%, a little bit more if you take a look at Big Tech and the Russell 2000. I think it's interesting. If you take a look at the intraday chart of futures right now, we definitely accelerated right around 8 o'clock and have been building since then. We did hear from Fed Governor Chris Waller this morning on Arrival Network saying that maybe July is when we could actually start to see some movement from this Federal Reserve.
Wow, that I think is earlier than a lot of other market watchers had expected, and maybe that's why we see that acceleration. What was the rival network?
CNBC.
Okay, we can say it because, we want to give you all of the intelligence you need in this trading day. Some more of our movers on our radar this morning. Tesla climbing the most among the Mag 7 stocks. You can see it's only a 2% gain, but that's worth something on what's bound to be a very low volume day. Smith & Wesson sliding after earnings estimates and missing earnings estimates, and the CEO warning of a cautious consumer. Even in guns? Even in guns, it seems like. I mean, you think of all the materials that go into that. I will say it might be exciting in the last 15 minutes of trading because, as we'll discuss at length, it is a triple witching day. Let's talk about Kroger a little bit. Kroger sales surpassed expectations. It also raised its full year sales guidance. Kroger is one of the consumer staple stocks, so maybe not surprising to see that people aren't necessarily pulling back on groceries. Yeah, absolutely, ahead of the weekend here. Coming up, SoftBank's big bet, more on Masayoshi Son's $1 trillion AI pitch. This is, for me, really the story of the day. We'll get into it with Caroline Hyde next. This is Open Interest. Let's get now to high interest. Look what's making headlines around the world. The White House says President Trump will make a decision on whether to strike Iran in the next 2 weeks. That's a 14-day period. White House Press Secretary Caroline Leavitt says the president's goal of preventing the country from obtaining nuclear weapons remains intact. However, she did add that if there's a chance for diplomacy, the president is always going to grab it. Meanwhile, during the Juneteenth holiday, President Trump took to social media to complain about too many non-working holidays and said it's costing our country billions of dollars to keep all of these businesses closed. He says the workers don't want it either. Workers don't want holidays, right? He says soon we'll end up having a holiday for every once working day of the year, which actually makes sense if you read it over and over again. Right now, there are 10 holidays on the New York Stock Exchange and 250 trading days. Meta is going up market with its new smart glasses. The company is rolling out new models with Oakley that are targeted to athletes. The new versions, which start at $399 and go up to $499, will include improved video quality and features like water resistance. There's a whole bunch of pictures of Mark Zuckerberg here, but if you actually look at the Oakley glasses, they're super unattractive. Yeah, I don't think they look that cool, so maybe it's better to just show the photos of Zuckerberg. But in any case, let's stay on tech because TSMC shares edging higher this morning. That's after Bloomberg has learned that SoftBank founder Masayoshi Son is planning a $1 trillion industrial complex in Arizona to build robots and artificial intelligence, with TSMC potentially playing a key role. OpenAI CEO Sam Altman recently told Bloomberg how hard it is to see a return on these types of investments.
The interesting question is if we knew how to get $1 trillion right now, which we don't, would we be able to deploy that profitably in the next few years? And I'm not sure about that, but I feel confident we can make $500 billion of value back.
For more, we're joined now by Caroline Hyde. She is Bloomberg Tech co-host, and it's funny to hear that from Sam Altman and then get this morning from SoftBank. And you think about $1 trillion, and to Sam Altman's point, how do you even start to deploy that and actually see an ROI on a number that big?
And maybe he's talking to the fact that they have been struggling to deploy it when it comes to Stargate. These things take time. And we know that Massa is a man who loves big numbers. He shocked and awed the market in VC by having a $100 billion vision fund. He then has already been deployed about $40 billion in terms of promises, where he's giving $30 billion to OpenAI if they live up to all their promises. He's investing in Stargate, of course. He's trying to line up, though, other investors along the way. He's also buying Ampere as well, another startup in the chip sector. So he's fully committed on his legacy within generative AI and building out the infrastructure. TSMC has already been plowing billions into the United States, promising manufacturing in Arizona as well, in Phoenix. So he's lining himself up with sort of easier targets of companies who already want to be deploying and doing manufacturing here in the United States. Look, he's already talking to Samsung as well about whether they'd be on board. But Massa is the artist when it comes to being kind of interesting with numbers, being able to rally other people around him to co-invest, like Saudi Arabia and Middle Eastern money. And indeed, maybe a bit of project financing will help you get to the $1 trillion number.
I mean, the thing is, SoftBank currently has $23 billion in cash, right? Which is, I know you might not have your calculator open, but far less than $1 trillion.
Really?
Especially since he's already pledged to invest $30 billion into OpenAI. He's already planning a $6.5 billion acquisition of Ampere. Like, I mean, okay, I'm going to build a $1 trillion data center too, but obviously I don't have the cash.
Well, he's got some interesting holdings. ARM is a big one, and he could sell off some legacy assets, some holdings in legacy assets, and deploy them in creative ways, leverage it up. So you see ARM as a potential way of doing that. BI is also saying, look, they've already been selling off T-Mobile stock. Remember, that was a big move earlier in the week because they sold about, well, $5 billion worth is what they ended up getting. So he does have levers to pull here.
But he doesn't even have a quarter. If he sold literally everything he owned,
yes, it wouldn't get
he would not have $250 billion.
And the point is, as well, like, what is he really envisioning here? He's envisioning China.
Right.
He's envisioning Shenzhen. He is envisioning putting Arizona to be this manufacturing beacon that they can replicate in other U.S. states as well. How much do the people in Arizona want this? Who knows?
It's a good
But
question.
They're going to have to get the government lined up. Already has been talking to people in the government, particularly Commerce Secretary Howard Lutnick, we understand, according to the story in the reporting.
Well, I do think it's interesting, to your point, Matt, that, okay, you think about the math here and the cash on hand, and okay, maybe he could use and tap some of his ARM holdings to fund it. It's still not enough. Maybe that's why you're not seeing much of a reaction at all in the shares this morning. There's that skepticism that traders are sharing with Matt.
This is Massa. He does these big, grandiose statements, these focus of intent, but we understand that there's going to be some maneuvering. This is why he used to turn to Wall Street for high executives to really do that. Rajiv Misra, who used to lead the Vision Fund, was from Deutsche. He was really the artist when it came to understanding how you finance things going into the future. So I don't think he's saying, I'm going to be deploying $1 trillion. It's just ultimately the vision might have to be $1 trillion worth. Sam Altman says you're going to get half of that money back. So that seems pretty painful. I mean, we also know Massa's not afraid to lose money on big bets. He's a risk taker.
That's true. That's true. All right, I think it is a fascinating story, and I'm looking forward to your program today because I'm sure that you and Ed are going to cover it well.
No Ed, just me. So
just Caroline.
Well, even better. Caroline Hyde is anchoring Bloomberg Technology today, and she will cover that as well as the, let's just say, ugly glasses that Meta is now planning to follow up. I mean, the Ray-Ban Wayfarers are an absolute classic, right? And this HTNS or whatever the Oakleys are called, I mean, they're not even frog skins. Coming up, we're going to talk about more than $6 trillion in derivatives that expire today. It's triple witching, which we always say could make some difference, but never, ever, ever has.
It's like treasury auction.
We'll ask Charlie McElligott why from Nomura. This is Open Interest.
Well, today is the quarterly triple witching event, and this could be the big one. Investors are bracing for $6.5 trillion of U.S. options to expire at the close today. That includes stock and index options as well as index futures. And this is one of the largest expiries on record. Could lead to more sudden stock market moves next week. I know Matt Miller is skeptical, so let's talk about it now with Nomura, America's cross-asset macro strategist, Charlie McElligott. He joins us on set right now. First off, it's great to see you.
Good to see you guys. Yeah, I mean, I was saying we obviously have known each other for a long time. Matt, my kind of evil twin brother
from another
it's
mother,
been an inevitability, I would say.
It's a bit surreal being between the two of you right
Don't
now.
get confused.
Yeah, let me turn to my left and ask you about triple witching. You heard Matt Miller downplay it right before we started here. How much do we need to care? How much does the average investor need to worry about the fact that you have $6.5 trillion worth of expiry at the close today?
Nominal.
Nominal.
Matters.
I'm trying to sell it.
Okay.
So when options expire, if they were to kind of assume expiring all at once, that's a bunch of gamma coming out of the market. And from a dealer perspective, that kind of removes hedging barriers, which then could kind of expand the range of outcomes. So I talk about a gamma unclench.
Yeah, tell us what that means.
So a stock's delta is kind of like the options price sensitivity to change in the underlying. Gamma is the second order Greek on that, which is the rate of change with regards to the delta. Why that matters is I try to kind of qualitatively explain, dealer long gamma or short gamma, in the sense of it can act as an accelerant flow when you're talking about dealer short gamma. If dealers are short options, whether they're short calls or short puts, it can act as an accelerant to kind of amplify moves into the prevailing market direction. In this case, if you have a sudden loss of gamma, and recently, right, the calls have picked up a lot of delta, and there's a kind of an incentive to monetize, that's a de-risking flow. You could see that delta come off, the gamma is removed, all of a sudden we could flush down. That is a potential scenario. However, I think kind of the phenomenon that you were talking about with regards to, the skepticism where we haven't had those kind of expansive, range of outcome events around many OPEX of late, although we have a number of profile ones kind of on the record, has been the amount of vol supply out there, the amount of option selling strategies and AUM at kind of highs in those strategies.
We have to go to break. During the commercial, we can talk about Kappa Kappa Gamma and the Tridelts.
Yes.
Always been a fan.
Nice.
Charlie McElligott staying with us. We're right back with the opening bell. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Just 20 seconds to go on a day when we all probably should have taken it off. S&P futures right now up about 0.5%. NASDAQ futures gaining 0.6%. As Katie was pointing out earlier, we got some acceleration after
Chris Waller
on CNBC said maybe we cut as early as July. That was seemingly unexpected, and as a result, you see traders pushing futures higher. Here's the opening bell on the New York Stock Exchange. Blitz the barriers with Novartis ringing the bell there, and down at the NASDAQ market site, Carver Bancorp ringing the opening bell, and a bunch of very happy, excited faces down there. That's going to boost your mood on a Friday, right?
Yeah.
Seeing the kids ringing the opening bell. What stocks are you watching today, Katie?
Well, I have more good news, and that's if you're a shareholder of GMS, because shares are up 28.5% at the open right now. That's after the building materials giant finds itself in a bidding war. Maybe you have both Home Depot and QXO have reportedly made offers to GMX. QXO has offered $5 billion. A spokesperson told Bloomberg today that that is the final offer. You can see shares up now about, again, 28%. We don't know what exactly Home Depot's bid is, but looking at the market, odds are that it's pretty impressive, Matt.
Yeah, I mean, the thing is, QXO is like a $13 billion company, and Home Depot is a $350 billion company.
That helps.
So it feels like they have more heft. Car buyers are turning to the secondary market. CarMax used car sales jumped 9% year over year, and earnings per share beat estimates, and a sign that demand is climbing for the secondhand models as the new car prices just continue to climb. You can see CarMax shares rising 8% to just over $70 a piece. We are back with Nomura America's cross-asset macro strategist, Charlie McElligott here. And Charlie, in terms of just the big picture, the index, right? The S&P 500 just bouncing around that 6,000 level. We'll be above it now after the open, but just barely. What is this market waiting for? Is it the cuts that Chris Waller was talking about this morning?
That helps the cause, certainly, if it's for the right reasons. In this case, the messaging there is that, it's for the right disinflationary reasons, as opposed to a growth shock, growth scare type of reasoning. Then you might have very much the adverse effect. I would say that right now, and kind of the reason that we've gotten back to 6,000 from where we were just a few months ago, was this, general overfixation with regards to all of the left tail downside scenarios, right? Everybody understands the growth downside scenario, which was, tariffs, create a price shock, right? It impacts consumption. And then you kind of have two bad outcomes. This is the macro bear case, let's say, this kind of stagflationary outcome, where the consumer then, is and their consumption is impacted, right? So fewer, lower top line sales. Or corporates, in order to support those sales, have to, take some sort of margin compression, eat some of those costs, and that leads to lower earnings. That's the macro bear case. I think one of the most important flows that's been lost when everybody's been so fixated on these left tail scenarios, and obviously, the President Trump kind of taco scenario has clearly mattered on the way back up. Where you found his kind of put activated and the market has stabilized and the worst case scenarios have come off the table. But what has ended up happening with those, with this flow that I'm talking about is that, so with this corporate uncertainty too, right? Not just the consumer, right? What are we going to do with our, CapEx spending? Into this kind of uncertain corporate spending environment, right, where maybe they are going to dial back the R&D or hiring or that plan to build a new manufacturing facility. And what they're doing instead is that they're authorizing all-time high share buybacks. And that is the biggest flow in the market over the past 15 years by like magnitude of 8. So huge source of demand for stocks right now.
Well, let's talk about that a little bit more because Darden, for example, Darden Restaurants out this morning, they had very good earnings, but they also authorized a $1 billion share repurchase program. And that just ties into what you're saying, that these buybacks have been an underappreciated fuel for this rally.
100%. And the way I think about buybacks, and I view kind of everything through the lens of optionality, but the way I think about buybacks is that, one, they're a shock absorber. So into a market pullback, i.e. kind of the last 2 or 3 months of tariff kind of, vol events and headlines, they help absorb. They're most active into pullbacks. Otherwise, they're kind of this latent passive bid under the market, supporting the market, while simultaneously shrinking the float of shares. So it's this vol suppressor. And in fact, as I said, it's this huge source of demand, much larger than a lot of these kind of day-to-day changes that we talk about with, leverage ETFs or options dealer hedging dynamics, that has been a massively underspoken part. And it's perverse, right? Because the macro bear case is corporate uncertainty on spending. Well, this is what they're doing with that cash instead. And it's driving the market higher, and the macro bears are kind of scrambling with that dynamic.
By the way, you mentioned building new, plant and equipment. You can write all that off. Now, if this big, beautiful bill goes through, R&D, you mentioned 100% R&D expensing. There is some incentive, right, for businesses to do that, even in an uncertain environment. Do you see them pulling the trigger?
Well, look, that's part of the thesis, and the irony is that, folks expected Trump 2.0 to look like Trump 1.0. And instead, and I call him the human Vivix, right? This idea that he is, the volatility of volatility. And he says he has a mandate to disrupt the status quo, right? So the status quo was kind of the prior regime. Well, he's expanding the outcomes in both directions. But as the market has become conditioned to that Trump put activated on the lows, and then the market goes higher and he, kind of ups his rhetoric again, you get this vol compression dynamic. But what also happened is the market started selling off and we activated that put. Trump 2.0, which was coming out of the gates with Doge and spending cuts on top of tariffs as sand in the gears of global trade, has slowly pivoted back to Trump 1.0, which is much more focused on deregulation, fiscal expansion, and obviously this big, beautiful bill, which on the margin is stimulative and maybe more so than people anticipated, both with regards to the timeline of getting it done and also to the way that it's been constructed, which is, you pull forward the tax cut benefits earlier and see the spending offsets later. So on the margin, I think versus expectations, that has also created this kind of relief with regards to the, the fiscally stimulative, policies. And a big part of that deregulation, fiscally stimulative Trump is, of course, like unencumbering, M&A and deregulation and things like that to allow and facilitate for this type of investment.
Charlie, we don't have a lot of time left, but you mentioned leveraged ETFs, and I have to go there because when you think about all of the inflows, the billions and billions of dollars that are pouring into these double leverage, triple leverage products, there's a lot of wondering out there about what that means for the motion of markets, whether we're starting to see the tail, that is these products, wag the dog, that is these actual underlying companies. In 45 seconds, what's your take?
Well, this goes back to what we started talking about, right? This idea, those products create a synthetic negative gamma effect in the market. So whatever the day's prevailing move is, they're going to feed into it due to their mechanical rules-based rebalancing at the end of the day. And with assets under management at all-time highs right now and the popularity of those products, particularly across retail investors, each day is its own ecosystem because those things are going to be forced to rebalance into the end of the day. They've been a huge part with those assets flowing into all, the highs and the bounce back here, a huge part of creating this I need to buy more into the end of the day to stay hedged the higher we go. Hence, it's synthetic short gamma. The higher we go, the more they have to buy to stay hedged. Conversely, on sell-off days, they can amplify the downside move too. But into this rally, when the assets have grown, for every 1% move, it's like a 99.8 percentile amount of stock to buy historically versus what they've done. So they're also a huge part of this rally.
Charlie, it's always great to see you. I'm so glad we could do this. I think Matt is the evil twin, actually. Through the course of this interview.
Good cop, bad cop. We can do this again.
I think you got to have this guy on ETF IQ.
I think so. I have a lot of inspiration and ideas here. Charlie, have a great weekend.
Thank you.
When
you
get
guys as
there.
well.
That is Nomura America's cross-asset macro strategist, Charlie McElligott. Meanwhile, let's get a check on this market right now and break down the rally that we have underway on this triple witching Friday. You can see we have a lot more green than we do red. More than 400 names are in the green right now on the S&P 500, 58 in the red right now. You take a look at what is gaining, and it explains why we're about 0.6% higher on the benchmark right now. Apple, Microsoft, Tesla, Amazon up there as well. A lot of your big tech names really punching their weight right now. Then you take a look at the downside. This is interesting. You have Eli Lilly. Eli Lilly has had kind of a rough week, now down 2.5% on this Friday. Accenture as well out with a disappointing earnings report, and you're seeing that reflected in the shares, as to is Broadcom, which we're going to talk about. Broadcom down about 8% right now, but boy, has it been on a hot streak. Let's take a look at the sector level as well and break down the market this way. Like I said, more green than red. Up at the top, you have consumer discretionary really leading the pack today, up more than 1%. Staples as well, Kroger out with good earnings, communication services. The lone loser today, Matt Miller, is materials, but it's a small decline at that. Materials down about 0.2%.
All right, we're, I think, likely to see a pretty low volume day. Famous
last words.
Right. Well, right now, average volume at time is, over the last 30 days, up 200%. So maybe I'm going to be wrong about that. It is triple witching, with the largest notional value of all time. Coming up, Broadcom pushing the limits of the Mag 7 to the Mag 8. We'll take a look at why the tech giants might need to add another seat at the table. This is Open Interest.
Welcome back to Open Interest. It's time now for top calls. Some of the analyst action in focus this morning. And first up, stablecoin issuer Circle extending gains after being initiated as a buy over at Seaport Global. Shares were trading near the analyst's $235 price target, have since come down. Remember, this IPO'd at $31 a share. So it's just been amazing watching Circle in particular. But let's talk about snack giant Mondelez, because it was raised to an overweight over at Wells Fargo on bullish signs for the Oreo maker. Despite record prices for cocoa, shares up a little bit over 2%. And finally, we end with Apple getting raised to buy over at First Shanghai Securities. Analyst Peter Hand's $230 price target is a nearly 17% increase for this Magnificent Seven stock, Matt Miller.
Yeah, so analysts bullish on Apple, but they're bullish Broadcom as well. Its run is making it a contender to join the elite group of tech stocks known as the Magnificent Seven. Analysts expect the chipmaker's sales, that's Broadcom, to jump 22% this year, another 21% 5% next year. Meanwhile, Tesla sales are expected to fall. So could Broadcom replace the electric car maker? Here to make that case is Bloomberg's Carmen Reinicke. And I guess it doesn't have to, you could make it the Magnificent Eight, as we've been saying today, but Tesla is shrinking as Broadcom is expanding, right?
Exactly. So one of the reasons I even started looking at this was I just kept hearing people say, you know, Broadcom is really making strides. It's kind of having a breakout moment. Shares have rallied a lot this year. And this rally has brought it over $1 trillion in market cap, and it now actually is the 7th biggest stock in the S&P 500. And so the original idea sort of behind the Magnificent Seven was those 7 biggest stocks, and also sort of that they had this growth aspect to them, that shares are really having a huge run up. So obviously this year we've seen a little bit more of a split in the Mag 7. About half are up on the year, and then we have some really big laggards, Apple being one of them and Tesla being another. And sort of in terms of not just share growth, but revenue growth and the business expanding, Broadcom makes a lot of sense.
Yeah, you make a good point that certainly the Magnificent Seven haven't been trading as a block necessarily. There's a lot of bifurcation when it comes to that group. I suppose we could just start saying the Magnificent Eight, and that's how the change.
That's what Nancy Tangler does, right? From Laffer Tangler.
Yes.
Yeah, I mean, you think about other acronyms, FANG, such as for example, it's really like this moment in time sort of phrase. And the Magnificent Seven, maybe to your point, that we're seeing more bifurcation, maybe that is just a sign of times that were.
Yeah, totally. And I think it's also important to remember that really these names, they're made up. They're things that we're using because they're quick and they're easy and we know exactly what we're talking about. But there really is been some expansion outside of that big 7 group, and I've even heard people talking about, you know, the big 9, the big 10. What, you know, should we include Oracle? Should we be talking about IBM? So yeah, there is definitely a shift going on, and you know, trying to come up with a new acronym, I guess.
I'm just looking through if you do an ANR function, analyst ratings on the Bloomberg terminal, analyst recommendations, you see a ton of analysts who are not buys on Tesla. I'm looking at like 30 who are not buys on Tesla. There are 23 who are not buys on Apple. On Broadcom, there's only 6, and they have 46 buy ratings. So analysts are super bullish this stock.
They are super bullish, and I think it's also important to remember that, you know, like sell ratings also come after record highs, right? And Broadcom was just at a record high right ahead of its earnings. So some of that isn't necessarily negative sentiment. It's just like, oh, maybe there's not a whole lot more room to run this year. But yeah, overarchingly, super positive and an interesting one to watch for sure.
Yeah, absolutely. Really enjoyed reading this article. I encourage everyone to go find it on the terminal.
They need a new ticker.
They
Why
do.
still Avgo?
Well, you know, we've got to come up with a new ticker for Broadcom, a new moniker for this group of stocks. So it's a long to-do list. Carmen, great to see you. Have a great weekend when you get there. That is Bloomberg's Carmen Reinicke. I will also note, if you take a look at the year-to-date performance of NVIDIA and Avgo Broadcom, they are neck and neck right now. NVIDIA up about 8.7% on a total return basis. Avgo Broadcom close behind with 8.2% total returns.
Right, NVIDIA is the only one of the Mag 7 stocks that is expected to grow in terms of the top line more than Broadcom.
True.
Which I now know because I read Carmen's story.
It's a good one. Everyone should go read it. Coming up, active ETFs now outnumber passive ones for the first time ever, but experts are skeptical of their staying power. We'll have that conversation up next. This is Open Interest.
This is Bloomberg Open Interest. Happy Friday. We've got to check on stocks for you that should boost your mood into the weekend if it holds. The S&P 500 is just over 6,000 right now, up 1/3 of 1%. The NASDAQ 100 gaining about 0.5%. Tech stocks are doing fairly well. Certainly the biggest of them is rising. Apple is up 1.75%. Microsoft is gaining about 1/3%. More news about layoffs at Microsoft. They continue to fire people. Now we're talking about the sales force. Darden Restaurants owns the Olive Garden. It's lovely. And earnings were better than expected. Plus, they've been doing well this year. So Darden Restaurants trading at $226 a share right now. Kroger up 6%. Obviously ahead of I guess it's not really a holiday weekend, but it kind of is a holiday weekend if you were smart. You took this day off, and it's a 4-day. Kroger up 6%. These are the biggest point declines on the index. Eli Lilly off 3%, and Accenture down 8%, holding us back from further gains. Katie, what do you see?
All right, let's get to the good stuff because it's time for our weekly ETF report. And actively managed ETFs now outnumber passive funds, another sign of change in America's $11 trillion ETF market. Active funds have absorbed about 40% of overall inflows into the industry this year, which is a record share. So let's break it down now with Bloomberg Intelligence ETF analyst Athanasios Psarofagis. So I feel like we could have had this conversation about all these record inflows, these record fund launches this time last year as well. So Athanasios, what is going on? What is fueling this now, what looks to be a sustainable boom?
Yeah, it's just all about adapting, right, to the market. And like you mentioned, there's more active ETFs than passive. So the industry is just not synonymous with passive, low-cost investing anymore. Not to say that that doesn't still exist. It's just about what's the next area that issuers are looking to differentiate, stop competing with the behemoths like Vanguard. So even though we call it active, it's not traditionally active. That definition is a little fluid. It's not like picking, it's leverage ETFs, it's options, it's buffers. So it's basically just anything that's not passive will kind of go into that active category. But I think it's just more about where is there potential to make money, where's there potential to grab assets, and it's not in the traditional low-cost beta stuff. It is in kind of outside of that box.
Yeah, I'm glad you made that distinction because, I mean, when we're talking about leverage ETFs, basically, these derivatives-powered ETFs, they count as active, even though, to your point, we're not doing old-school stock picking here. So the number of launches that we're seeing, now that you have active funds outnumbering passive funds, what does this look like on the other end? Is there enough demand to actually populate all of these different funds, or are these going to eventually turn into closures?
Yeah, that's a fair point. I think we'll definitely see some closures. I mean, we see it on the passive side, but I mean, the first starting point is you need the products, and then you kind of see if the assets will follow over. It's slowly moving over. So active is definitely getting attention. Of all the flows this year, almost half are going into one of these active categories. So you're seeing that there is some demand, but I agree with you. I think we might see some closures because there's just a lot of products. There's 4,000 plus ETFs. It's only going to get more competitive. There's only going to be more products coming. So, as we're on the passive side, we're going to see some closures. But I think that the demand is there, and this is why the issuers keep bringing these products at basically a record pace.
What's the next? I mean, when we get ETFs in 401ks, is that the next big milestone for this group?
I don't think so. I think what is happening, or which could be a big change, is this share class ruling that might happen this year. So basically, they can allow mutual funds to tack on an ETF share class. This will, if you think there's not enough launches now, if this happens, this is going to be a tidal wave of ETFs coming into the market. But the 401k thing is another thing that could happen too. So there's only tailwinds behind the industry. So it's only going to intensify. We're only going to see more products. So everything is just shifting over to the ETF world.
Yeah, it's nuts. If we do that, get that share class approval, there's estimates that we could see thousands of new ETFs coming to market. So we're both going to be busy. That is Athanasios Psarofagis of Bloomberg Intelligence. Have a great weekend. Tune in to ETF IQ on Mondays at 12 p.m. New York time. And great news, you can read all about the ETF industry in my weekly newsletter. That is Bloomberg.com/ETFIQ newsletter. Matt, I assume you subscribe.
I do, and that's why, to me, this was not really news, right?
That's
we were
great.
talking on the call this morning, and you were like, people don't realize that ETFs aren't all passive. And
They
I was
don't.
like, they should watch your show.
I agree. Thank you.
Great to get some time with Athanasios Psarofagis there as well. Coming up in the next hour, Sarah Hunt says the spike in oil and the Fed's hawkishness puts investors in a tough spot. We are 30 minutes into the trading day on this Friday that comes after a day off and before 2 days off. That's why I call it an orphan.
Yeah, but then you look at volume. And
It's
for
huge.
A summer Friday, that's pretty big.
Probably because of triple witching. We see volume at double the average over the past 30 days.
Yeah, don't panic.
Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today. So we talk about triple witching. It probably, in the grand scheme of life and time, doesn't matter that much. Could explain some of the volume we're seeing today. And we're going to talk about that 6.5 nominal $1 trillion event. Investors preparing for that triple witching that could fuel more volatility.
Look at these dramatic pictures of traders on the New York Stock Exchange freaking out about triple witching. Look at this watch, 250 grand for that one. Is the market for luxury watches taking off? We'll speak to the CEO of Bezel about the competitive market for high-end timepieces.
And Robinhood CEO Vlad Tenev revolutionized retail investing. Now he wants to shake up the AI race, too. We'll have details on his venture next. We do have some breaking news here, Matt Miller, about GLP-1, something we talk about often between the hours of 9 and 11 a.m. This coming from the ACC, saying that GLP-1s should be first in line to prevent heart disease. That is a pretty big statement coming from the ACC.
Whatever that is.
We'll continue to
the
follow.
The Athletic Club of Columbus is what I think.
No, I believe it has something to do with cardiology. Hopefully we get a little bit more detail. But take a look at shares right now. Eli Lilly had been lower on the day. It still is, but some of those losses coming in. Novo Nordisk as well lower. We'll see how this trade develops because pretty big statement, again, coming from this cardiologist. Society.
I have to say that so as a man over 50, right, who tends to gain weight right in this area, like the fattest part of me is around my heart, I really want a weekly dose of GLP-1 drugs, but I don't want to pay $1,000 a month.
And the ACC is the American College of Cardiology.
But it's also the Athletic Club of Columbus.
Yes.
I grew up swimming there.
There you go.
All right, let's begin the hour with the stocks on the rise as Fed Governor Christopher Waller says rates could drop as soon as July. He said that on CNBC. As a result, we have the S&P 500 up 0.3%, and Chief Market Strategist Sarah Hunt from Alpine Saxon Woods here with us. So, Sarah, we said you're going to tell us about what a hawkish Fed does to this market, and Waller is more dovish, obviously. Is this an anomaly? I mean, is he kind of one lone voice on the FOMC that wants to wait until really September?
I think that absent the issue that's going on right now in the Middle East with Iran and Israel, I think it would have been easier to push at the Fed and say, you really need to cut rates because you have not seen the acceleration in inflation that they were looking for. But I think the problem that this has there's a huge problem for many reasons. But if we think about from a market perspective and an inflation perspective, lower energy prices have been helping with inflation. So higher energy prices are not going to do that. And I think that gives the Fed far more cover to wait and see, and I think that that's what Chairman Powell wanted to do anyway. So I think that sort of the recent events make that easier for them to stand pat. So I think the Fed is a little bit collectively more hawkish than it was.
But are oil prices going to stay here? I mean, Brent crude down 3% today as Trump backs off. The taco trade comes in, right? $76 a barrel.
It's a good question, and that's a big bifurcation for markets, because if oil prices don't stay high and this does not turn into a larger conflagration, then I think that the markets are going to be very happy with that. I think that that's your binary thing is oil prices don't stay high, this gets better, versus they do stay high, something happens in the Strait of Hormuz, and or there's a bigger conflagration, and then higher energy prices are going to derail a lot of the growth that we're expecting and a lot of the things that people were looking forward to, I think.
Yeah, I mean, we've been talking this week about how it feels like there's never a sustainable risk premium priced into markets. I do want to take a look at the sectors over the past 5 days, though, because energy up top, higher by about 2.5% over the past 5 days. That is your lone gainer over the past week, which might be surprising to some. So what do you do in this situation? There's so many impossible to know the answer to questions out there. Do you chase the energy rally a little bit? Do you add there as a hedge?
Well, the energy sector has been uninvested or less invested for a long time than it had been traditionally. And that was partially on the back of a transition and partially on the back of there's just been an unevenness in both commodity prices and what people are expecting for demand. I think it is not a wrong thing to want to have a couple of good energy stocks in your portfolio. We've always liked the pipelines. They've got reasonably good dividend yields. But now that you have slightly higher oil prices, there are some E&P companies and some of the majors that look attractive on a dividend dividend yield basis. And I think that there's nothing wrong with having some of that. It gives you some participation when things move like this, but at the same time, you've got a good dividend yield to wait for it when things are not that bad. And if we think there's going to be growth, then energy prices should not be continuously low.
By the way, do you like gold, Bitcoin, the euro, European stocks, EM? I mean, it seems like people are looking for alternatives, right? And we had a great story on the Bloomberg terminal today that currency traders, for example, are replacing the dollar in like 15 to maybe 30% of all the contracts they trade.
It's an interesting question, and that goes back to whether or not the dollar stays, the reserve currency, and certainly where it's been. But if you look at, we're down.
It can stay the reserve currency, but just be much less of the reserve
smaller.
currency, right?
And I also think that, the dollar is down 10%. If you go back and look at a chart for the last 2 or 3 years, though, it's not like it's down from a height and it hadn't been lower before. So I think that there's a put and take for that for companies that do have revenues outside the U.S. and do not, whether or not that's good for them in the end. But I think people are looking for alternatives, which is why gold and Bitcoin are doing so well. And I think that gold is one of those places where people go when they're not really happy with any of the currencies in the currency market, because they're looking at something that has relative value against the whole batch as opposed to just the one that's going to win.
Yeah, it has been stunning to watch the run in gold. Matt mentioned European equities. There was a story on the Terminal 2 this morning about Goldman and Citi. They basically see the European economy, the strength there, continuing to fuel this performance that we've seen in European equities so far. Where do you fall on the Europe, the rest of world equity conversations versus the U.S.?
So you had 2 great years of U.S. outperformance, right, prior to this year. And there has been a continuous desire to see some other parts of the global economy performing better. I think the changes in some of the fiscal regimes that are going on in Europe, if they are actually continued and the spending does come about, could drive more growth there than we had seen in the prior couple of years. I still think, though, that the U.S. is a great place to be and a great place to invest, and you can get a lot of exposure in U.S. companies that do business in other places. So we tend to be more U.S. focused, but I also think that a lot of those switches, when they happen, don't last that long. And so to the extent that you had some outperformance outside of the U.S., which is a bit of a catch-up trade to the U.S., is that going to last for the next 18 to 24 months? And that's really sort of the question, because we're not that short term. We tend to be much longer term in our trade.
I want to just go back to the point you made about the dollar, because I've looked at it over a 20-year basis, and you can see that we're not nearly to the levels we were over the last 5 years, the last 10 years. The question is, after 3 more years of this, right, does the rest of the world, do investors return to, if we get another regime here in the U.S., do they start to trust us again? Or is this like once bitten, twice shy?
It's really going to depend on what the economy does and what the global economy does, because in the end, the U.S. tends to have outperformance on a global growth basis. It can have periods of time now where that's in question.
But we've also been the police to the world. We've also been the supporters of NATO. We've also made promises and kept them. So is that different now?
From an investment standpoint, I'm going to go back to, it's going to be about earnings and growth. And it's going to depend on that. And yes, on the margin, people may say we would like to stay out of the United States, or different funds may say we're going to make some changes. But in the end, it's going to be about relative economic performance. And if we get the performance, then that's going to drive equity investors. And if we don't, then the odds of the rest of the world having great performance are also not that high, because the U.S. is a big driver, regardless of what happens to everything else.
All right, Sarah, it's great to speak with you on this Friday. Appreciate you coming into the studio. That is Sarah Hunt of Alpine, Saxon Woods. And I think this is a really important question, Matt, that you're asking about whether this sort of stature lasts the next 3 years, or, some of the dynamics when it comes to the investability of the United States. Does that transcend any one presidential administration? I'm sure that's a question we're going to be asking over the next 3 years as well. 10,
20 years maybe, right? Because I think the agreement has been, we'll buy all your stuff and you keep financing our deficits with those profits.
Yeah.
And now we're saying we don't really necessarily maybe want to buy your stuff and
continue to give us the money.
Exactly. Or like maybe we don't want to run huge deficits. Of course, we're still going to run huge deficits.
It's a difficult pitch, but in the Sarah Hunt view of the world, it comes back to earnings, it comes back to growth. And on that note, let's take a look at some of the single stocks moving this hour, because we did have Actually, a few earnings today on this summer Friday. CarMax shares rising after the used car seller reported results that beat estimates. It was higher to the tune of about 8%, still up 3.5%.
Yeah, so some big gains there, and as David Welch was telling us, we could see the price levels for used cars continue to climb over the next few months as new car prices rise. Darden also surging on strong results. It's the parent of the Olive Garden as well as Longhorn Steakhouse. I've always wondered if you get free breadsticks, does that fill you up too much to order more stuff, or does that sort of whet your appetite so you order more stuff?
I've never really understood the phrase, that's how they always get you when it comes to the free bread, because it certainly fills me up. But maybe that's why you come to the restaurant. We're going to continue to discuss that in the commercial break. But let's talk about Kroger sales passing expectations, a sign that consumers are still spending on groceries and other essentials because they have to. And that's why you have shares up about 7%, Matt.
Coming up, democratizing private equity. We're going to speak next with Ardian's Mark Benedetti on where he sees opportunities in the PE market. And what I'm most interested in is, do retail investors get a shot at this? Should they? This is Open Interest. Getting out of high interest and look what's making headlines around the world. The top cardiology organization in the United States says exercise and diet are not enough to prevent heart disease. Latest guidelines from the American College of Cardiology, or the ACC, recommends using GLP-1s such as Wegovy and Zepbound earlier to prevent heart disease. And SoftBank may be making a $1 trillion AI play in the U.S. Sources telling Bloomberg Masayoshi Son is looking to team up with TSMC to build a $1 trillion industrial complex in Arizona. Facilities would focus on robots and artificial intelligence. Son is also exploring partnerships with other tech companies, including Samsung, to raise the funding. And Meta is going slightly up market, I guess, with its smart glasses. The company is rolling out new models with Oakley that are targeted to athletes. This is what the models look like, and the athletes are apparently people who ride roller coasters. The new versions, which start at $399 and go up to $499 for a special limited edition, include improved video quality and features like water resistance. What do you think, Katie?
I think we all know how you feel about those glasses.
I mean, they're not Ray-Ban Wayfarers, are they?
They're not. But, you know, they'll probably appeal to someone out there, and we should talk to that someone. But we have to talk about private equity right now. It's expanding its reach to different types of investors. With over $170 billion in assets under management, Ardian is helping to lead that shift. Joining us now is the company's executive president, Mark Benedetti. He co-leads the firm's secondaries and primaries vertical, which just raised a $30 billion fund earlier this week. He joins us now. Mark, great to see you in person.
Thanks for having me, Katie.
So let's talk about what's often referred to as the democratization of access to these private markets. A cynic could say that, okay, you've run out of your traditional sources of funding. Now you need to start tapping retail investors. Give us the other side of the argument.
Yeah, I think so. When you zoom out and you look at private markets and how they've performed first over 5, 10, 15 years, there's a clear outperformance over public markets, okay? And that's tested and demonstrated empirically. Now, if you look at the volatility that comes with it, it's much less. So if we went to our portfolio during the great financial crisis, you know, peak to trough public markets down, call it nearly 60%, we were about a third of that down, okay, about 20%. Look at COVID in March of 2020, about the same ratio. So you have a lot less volatility. And investors are saying, I kind of want that. I want exposure to that. In the public markets, in the public pension plan environment, they're very heavily invested in private markets, 15%, let's say. On the individual side, it's around 2 or 3%. So it's way underinvested.
I mean, I look around, my mom's a teacher, right? And so she has TIAA, CREF, or if you're a cop in California, you know, you have CalPERS, and all of these big pension systems, they're allowed to invest in private markets, but I'm not in my 401k. Doesn't that need to change? I want higher returns and less volatility.
That's a great point, and I think it's a key question. If I ask you, or the three of us, do we need daily liquidity in our 401k? The answer is no. A lot of us park that capital there for the long term. So why not have a private market solution? If I look at the whole investable universe in all of investable assets, right? $300 trillion, about $150 trillion is from the private investor, $150 trillion from institutional investors. On that whole 150 trillion, if you take only 2 or 3%, it's a microcosm, right? That needs to grow. Could it be 10? Could it be 15%? Maybe, but before that happens, you have to change things. Right now, the plumbing of the system is too complex.
Let's talk about different fund structures, different wrappers for how retail investors might actually get access to private assets.
And she goes straight to ETFs. You see that?
Well, I'm going to talk about another fund structure too. ETFs. You're starting to see some of that come into the ETF space. Of course, Apollo and State Street partnered on an ETF recently. Hasn't seen a ton of interest. You also have interval funds are becoming a very popular way to expose retail investors as well. Where do you fall on how actually retail investors should be accessing the private markets?
Yeah, I think you're right. I think today, if you look at that 2 or 3% I referenced, that's really the ultra high net worth investor, okay? Last year, Ardian, we raised $20 billion of capital. About 20% of that was coming from the private investor, which is a big number. It's a record-breaking year for us from that segment. But it's all coming from this ultra high net worth investor. Forget about mass affluent, forget about retail. So there's a lot of vehicles that are coming up now that give that kind of liquidity windows every quarter, that give them the way to access that. But before it can be added to 401k plans, before you can put it into target date funds, there's a lot more work to do. A lot of the rules have to change. But what you see is a clear demand for it. And if I look at the overall ecosystem of private markets, today we're at $13 trillion. If you take just conservative estimates by 2030, that's going to be $20 trillion and could be 25 or 30 if you get this inflow of retail investors.
So are you involved in some kind of lobbying effort? Are you involved in a private markets trade group that going to Washington and saying, look, these regulations are seriously strenuous and they're not helpful to people who want to grow returns to retire?
I think to your point, what's key for us is showing that private markets can be a force for good in the economy, okay? Sometimes it gets labeled a certain way, which is wrong. If I look at how we've invested at Ardian, in the last 10 years, we've created 14,000 jobs across our direct portfolio. That's very strong. We share value with the existing employees of companies, so we've been value sharing. Whenever we have an exit on a portfolio company, we share value of the exit with the employees. We've shared capital gains with 40,000 employees across 49 different companies since 2008.
Right.
So part of our job is to show that we're adding growth, we're growing assets, we're growing employees, we're a force for good in the economy. And when you can do that, maybe that'll unlock some of the rules we're talking about.
And Mark, we have less than a minute left, but I want to talk about the exit environment right now. You're starting to see somewhat of an uptick when it comes to M&A, when it comes to IPOs. Not what we were anticipating back in January. Do you see that continuing to shift, or what's your current feelings when it comes to exits?
I'm cautiously optimistic. Last month was our biggest month of exits in the last, call it 14 months. So there's a small green shoot, but that's on a pretty small base. The last 14 months have been pretty small. And we're still rolling around 10% of the current NAV of exits per year, which is too small, okay? So you need more of that. But to your point, what's filling the gap? Secondaries. So secondaries last year was a third of everyone's exits in their private equity portfolio. Today it's a $200 billion per year industry. That's going to grow to $300, $400, $500 billion, especially as the pie gets bigger, but as the percentage gets larger of what people trade. That's why, we raised a $30 billion fund for secondaries at Ardian. We're the biggest secondaries investor in the world, but we're still in the third or fourth inning of what could be a huge boom.
Great having you on. I hope we can get you back because I think it's really fascinating stuff. Mark Benedetti there of Ardian. Let's get a quick check on what's going on in the markets here. And we are seeing a 0.25% gain on the S&P 500, not able to hold above 6,000 for now at 59.96. The NASDAQ is not doing quite as well, but also positive. The 10-year yield up 3 basis points to 442. So we've seen significant move in the 10-year yield.
Yeah, that's true. And if you take a look at the S&P 500 on a week-to-date basis, we're nursing very slight gains of about 0.3%. So we'll have to see how this trade develops. It is triple witching. Things could get kind of funky around the closing bells.
Spooky.
Yeah, don't get too scared though. Stick with us. This is Open Interest.
All right, let's get a quick check of what's going on in this stock market with the move screen, MOV on your Bloomberg terminal. It's the most dynamic way, I think, to look at what's going on in the equity indexes. And this does not look great, right? I mean, we're just losing all of the gains that we had. This looks good. We're up on 400 stocks and only down on 100. But it's really a defensive move higher. If you take a look at the industry groups, you can see that the big gainers are energy, real estate, consumer staples, and utilities. That's very defensive there at the top. So you want consumer discretionaries to lead. We've seen IT leading as well as comm services. Those are the hyperscalers, but they're not on the up and up today. So Katie, it looks like these gains are defensive and we're losing them.
Yeah, when I checked that board just an hour ago, you only had one sector in the red. So to Matt's point, really losing our momentum quickly. Now coming up, we're going to turn our attention to luxury retail consumers. We'll talk to the co-founder and CEO of Bezel. This is Open Interest.
The high-end luxury business has proved to go through crisis without any problem. In 2008, we didn't have any problem. COVID, we even didn't feel. Today, hopefully, I mean, I know that there is a crisis in luxury business. We don't feel it at all.
That was part of my conversation with Richard Mille, the Swiss luxury watchmaker at the 24 Hours of Le Mans last week. The industry is getting another player in the very crowded resale market. Bezel was founded in 2022, but with some special investors. John Legend, the singer, the CEO of Fanatics, Michael Rubin, Endeavor. The site offers authentication and has over 26,000 watches for sale. Let's talk to the co-founder and the CEO. He joins us now, Quaid Walker out of Los Angeles. Quaid, I was in Le Mans last week, and obviously, you know, car guys are watch guys there. So let's first talk about how you deal with so many competitors, right? You've got Watch You Seek and Chrono24 and eBay and Bob's Watches, and there's so much out there. Why does somebody come to you to buy or sell a watch? What's your USP?
Yeah, so I think we started the business because we were watch collectors ourselves and didn't feel like we were being served the way that we wanted to be served as a collector. And I think it ultimately comes down to a couple of factors, largely looming around trust for us. So we focus deeply on the product and the product experience. So every buyer is paired with a concierge in-house. It's kind of that mix of a technology business with, you know, the age-old experience of buying something that feels like a luxury experience. We obsess over scaling the inventory to make sure that we have everything you would imagine in stock. So we have just north of $750 million in listings on the platform. That's everything from, you know, a $750 watch all the way up to a multi-million-dollar Patek. And then the core differentiator for us is we authenticate everything in-house. So once you transact on the purchase, it's overnetted to our authentication team. We run it through an authentication check, a diagnostic check, a performance check, make sure it's never reported stolen, with the ultimate goal of being able to scale up your collection, but doing so in a way where you know you can trust that you're getting what you're expecting.
Batman is the name of that Rolex.
Oh, I love that. I love
Just so you know.
Yeah, I had a pony named Batman.
Katie had a horse named Batman, yeah.
In any case, Quaid, I am curious here. I mean, when it comes to the tariff landscape, is that having any impact on your business? This is obviously a luxury purchase, and the common wisdom is that luxury remains resilient in almost any economic cycle. But you think about the trade uncertainty, you think about consumer sentiment right now. How is that factoring into your customer?
Yeah, so the tariff environment's been really interesting for the secondary watch market. I was in Geneva for Watches and Wonders, which is like one of the biggest moments in the watch world where a lot of the primary brands release their new models in April. It happened to coincide directly with the timing of the tariffs being announced. And so there certainly was a lot of speculation. Our business is US only, so it shot up purchases in April and May. A lot of buyers in the U.S., I think they were waiting on purchasing a watch, tended to push in the direction of transacting quicker rather than later because they're worried about the tariffs coming into play. And then now coming into the end of June, early July, we're seeing a lot of the markets. The prices are increasing for the first time in a long time because the primary brands are starting to throttle the supply that's coming into the U.S. market because of tariffs. So it's just moving prices up. I think the demand is stronger than ever, but we're kind of in this interesting place right now where the prices haven't totally settled with what the new market price is given this kind of speculative tariff environment.
Quaid, what do you do with, I imagine a lot of people selling watches have had them sitting in drawers forever, which is why they decided to get rid of them. The date function doesn't work. The crown is broken. If you take a Breitling to the shop down here on 57th Street, they tell you it's going to take about 16 years to have it serviced. How do you deal with that kind of inventory?
Yeah, so the way that we deal with inventory is our whole core function is to make sure things are working the way that they should when they're passed on to the customer. So we block around 27% of transactions that are going through the platform, whether that's because they're completely inauthentic or they're not working the way that they should. So our promise to the customer is you're not getting a watch that falls into that category. For the customers that are sellers on our side that are trying to sell something through that may need to be serviced or things like that, we work with providers or we offer the service ourselves to make sure the watch is in the right condition it should be to be passed on to another customer.
So you have the seller who found a watch in their drawer and decided to sell it. You also have the seller who bought the watch at retail and then flipped it and is looking to sell it on your site. My understanding is that you saw a lot of that sort of activity in the post-pandemic boom. Has that subsided at all?
I think the market's still as frothy as ever. We saw a massive correction in the pricing. So, when we launched in June of 2022, a lot of these watches were 40% higher than they are today. So they're still trading, a lot of these Rolexes are trading at double retail, retail being what's available in the primary market. But, we were seeing insane valuations for these pieces, in the COVID time. So still massive multiples, still very frothy, but it's certainly come down a bit from the highs of the kind of post-pandemic boom. Now we're seeing it creep back up in this kind of tariff environment, though. So it's the first moment in the last 2 or 3 years where we're starting to see watches come back up.
On the Rolex side, first of all, if you flip it, your AD is never going to help you out again. But they were trying to, I believe, double production. In terms of the supply and demand, do you think the manufacturers have really started to work to make more? Or, like the Holy Trinity, do they appreciate very limited supply?
I think it depends on the brand, and it depends on the goal of each of these individual brands. I think a lot of the watches themselves are not manufactured or intentionally constrained. I think it's just challenging to make a lot of these high, complicated pieces inherently. But obviously, I think the brands do know what they're doing, and they love a healthy secondary market for their pieces that drives demand and makes the wait list long. It's like a lot of these brands, I think luxury generally tends to think in, very large spread out milestones. And the goal is how do we make our brand last for 100 years, not necessarily how do we maximize the sales we have each incremental year. I think Rolex is a great example of this. They could double their prices and still have the same demand, but they choose to do so very intentionally. This is kind of one of the standout years where we saw Rolex actually increase prices a meaningful amount because of gold prices, and then now an additional 3% because of tariffs. So I think this is changing, but fundamentally, I think the goal is to kind of keep the brand existing as long as possible, and obviously sustaining that massive demand on the secondary market.
All right, Quaid, thanks so much for joining us. Fascinating story. Definitely a site to check out. Quaid Walker there of Bezel. By the way, be sure to tune in to Bloomberg Television tonight, 7:30 p.m. Eastern, because it's Friday, and what else would you be doing at 7:30? We've got our special coverage. And I must say, I've watched it. It is really good.
That's you and Hannah Elliott, right?
Yes, we went to the 24 Hours of Le Mans together, and we've put together a package with the help of Ann Torres and Jen Haley and a huge team, Emilio Almonte, of really talented people. So you'll see Jim Farley in there, you'll see Adrian Hallmark in there, you'll see Richard Mille, you'll see Jensen Button. I think it's really good stuff.
And
I would probably DVR it tonight and then maybe watch tomorrow morning.
No, I would tune in at 7:30 tonight because you see Matt Miller every morning in the morning on weekdays. But if you really want to see Matt Miller in his element, definitely tune in and check out that special. I don't know if I actually will, but I'm sure.
Your husband might.
That's true. That's true. I'm sure he would be interested in.
Watch it, Joe.
Yeah, there you go. Let's get a check on these markets, though. If you take a look at this rally in the S&P 500, it's fading. We did briefly turn negative. You can see that we are nursing slight gains right now, slight weekly gains we're trying to hang on to when it comes to this benchmark as well. And it's the same story if you take a look at the NASDAQ 100 and that bond market sell-off continuing a little bit today. All right, let's talk about some news that came out in the past hour, and that is that GLP-1s such as Wegovy and Zepbound are said to work better than diet and exercise. That is according to new guidelines from the American College of Cardiology that they should be used as part of the first line of defense for obese patients. Bloomberg senior editor for health, Michelle Cortez, joins us now. So give us some context here, because reading over this story, this seems like a pretty huge statement that GLP-1s are being elevated to the same level, if not higher, than diet and exercise.
Right. Well, the nation's cardiologists have kind of just agreed with what the rest of us know, which is that telling somebody to eat clean and go to the gym is not going to do it when you're at risk of heart disease. And of course, heart disease is a leading cause of death in the United States. And what they really want to do is make a difference. And what they're saying is that difference is these GLP-1s, which are huge drugs already. And the reason they're not bigger is because we can't get insurance for a lot of them.
Yep.
So the cardiologists, they're looking at the money, they're looking at the health, they're looking at your heart, and they're saying that doctors should be prescribing these GLP-1 drugs at the same time that they're telling their patients to exercise and eat right.
So the problem is, as we talk about on this show a lot, the insurance companies aren't as interested in preventative. Like, I have pre-diabetes and a BMI of 28, and they say, no, you have to actually have diabetes and a BMI of over 30 before we'll cover this. So, I mean, I'm probably going to get there, right? But I would prefer not to.
Right, right. You just need to eat a little bit more. What this is doing is broadening the risk, right? So if you have a parent who died of heart disease, if you have other signs, if your blood sugar is a little bit elevated, if you have high cholesterol, if you have high blood pressure, anything that puts you at risk for heart disease, these cardiologists are now saying that you should be getting a GLP-1 as well at the start. And when they're saying it, that means that their doctors are going to be prescribing it, and they're going to be going to health insurers and saying this is something that should be covered. And of course, it's the money, right? It's, you know, when you're talking about a blood pressure drug, it is always the money.
In this country. Only in this country, right?
That's true.
Because here it's $1,000 a month. If you get it in the UK, it's 150 pounds, you know?
Well, I do want to point out that you take a look at shares of Novo Nordisk, you take a look at shares of Eli Lilly, they're down on the day. They're not reacting too much to this news. Why is that? Why is this not too big of a deal for some of these companies that make these GLP-1s?
Right. Well, it is actually really big news. It is something that has just happened. And of course, as with anything else, there's other things that are happening in the market as well. Lilly is down because they got some bad news for their Alzheimer's drug, which is really important for them in Europe. Maybe less likely to cover it. It's here in the U.S. So, Matt, to your point, we see things that are different happening in different parts of the world. So Lilly's down a little bit perhaps on Alzheimer's drugs. Novo, they're not based here, so their shares a little bit trade differently. But this is actually very important. We're wondering if other people are going to catch up with us.
All right. Well, Michelle, it was great to get you on. Thank you so much for joining us at such short notice. Michelle Cortez there, Bloomberg's senior editor for health, talking to us about the ACC on GLP-1s. Let's get a look at some of the other stocks that are moving this hour as the market sinks. We still see big gains for Circle. And this is just
amazing.
An amazing story, right? 2 weeks ago, this stock sold for $31 a share in an IPO, and it is now trading for $230 a share.
Yeah, I mean, you think about stablecoins, their place in the crypto industry, they're kind of the lifeblood of trading. They make a lot, they facilitate a lot of the trades that happen in the crypto world, but even still, to see another 15% gain on top of what we've already seen, just stunning. We also should talk about GMS also surging after a report that Home Depot has made an offer for the building materials firm. potentially sets off a bidding war with QXO. It made an offer for $5 billion earlier in the week, but as you pointed out, Matt, Home Depot, obviously, magnitude's bigger than QXO.
Yeah, and I think QXO is like a $13 billion company, Home Depot, $350 billion company, and QXO has said, this is it.
Yeah.
Like, we've put $5 billion on the table, and that's the full offer.
Yeah.
There's no sweeteners coming. No one knows if they mean that.
Yeah.
But if they do, Home Depot just has to say, like, okay, here's 6, right?
Well, the market is waiting to get details of what exactly the Home Depot bid is. I believe we don't have that yet. Shares up 29% in anticipation. Smith & Wesson, what a horrible Friday for the gun maker. They reported disappointing earnings. The CEO says that consumers are holding back on spending because of concern about the economy. We've heard something similar across different industries. Apparently, that applies to gun makers as well.
Yeah, I mean, it's an interesting story, and it would be nice to look into a little deeper into their sourcing, because they obviously use steel predominantly, right? I mean, polymers, depending on what you're trying to sneak through a metal detector, but steel, and you've seen massive tariffs and increases in tariffs on that, so you're going to see higher prices. And this is another, like the car industry, another example of a product that has a really strong secondary market.
Right.
So if the prices are too high for this revolver new, I can go and look at it used and get a pretty big discount.
Cars, guns, and watches, strong secondary markets, as we've talked about
that is true
on this show. Coming up, a new race could be shaping the future of artificial intelligence. On today's Wall Street Week, Robinhood CEO Vlad Tenev discusses how mathematical superintelligence could revolutionize AI. This is Open Interest. Time for our Wall Street Week conversation. And while large language models like ChatGPT and Gemini are dominating the AI space, they're not without their faults. David Weston speaks with Vlad Tenev about his latest venture, Harmonic, and how it's taking steps to conquer AI's biggest challenges.
When we saw GPT-4 come out, along with a bunch of improvements in the mathematics community around formal verification, Tudor, who's my co-founder and CEO of Harmonic, and I got very, very excited about building something. We thought that the time was right to actually build something in mathematics that combined the state-of-the-art in that field with the state-of-the-art in AI.
Tenev's new firm, Harmonic, hopes to achieve something that still belongs to the realm of science fiction. Beyond artificial narrow intelligence like ChatGPT, which can perform specific and limited tasks, beyond even an artificial general intelligence, which could learn and adapt like humans. Tenev says his goal is to help create what he calls a mathematical superintelligence.
So mathematical superintelligence is artificial intelligence that can reason and solve math problems at a level exceeding the most advanced mathematics researchers. And we think that developing such a system will not only greatly accelerate the progress of mathematics, but it'll also accelerate progress in all fields of science and technology that depend on mathematics. I think the main problem with large language models and AI systems as they're currently designed is that they very, very confidently can tell you the wrong thing. So there's very few controls over what we call hallucinations. And it can be very convincing in its incorrectness. And so I think that's a huge problem. And that's, by and large, what's hindered the adoption of these AI tools in mission-critical industries.
And that was David Weston speaking with Robinhood CEO Vlad Tenev. You can catch Wall Street Week tonight and every Friday night at 6 p.m. New York time. And coming up on Open Interest, President Donald Trump says he's giving diplomacy a chance before deciding whether or not to strike Iran. We'll get the latest out of D.C. next. This is Open Interest.
I have a message directly from the president. and I quote, "Based on the fact that there's a substantial chance of negotiations that may or may not take place with Iran in the near future, I will make my decision whether or not to go within the next 2 weeks."
And that was the White House Press Secretary Caroline Leavitt speaking for the president, reading out the president's statement on plans for Iran after leaving the G7 suddenly, appearing in the war room, telling everyone to evacuate Tehran. Is this the taco trade again? Let's get to Bloomberg's Washington correspondent Tyler Kendall for more. So now he says he's going to wait 2 weeks, which is that Trump speak for like this probably isn't going to happen?
Yeah, hey, Matt. Well, we have heard President Trump use 2 weeks as a timeline before for action, whether that be tariffs or trade measures, for example, and then it doesn't actually end up coming to fruition. But at the same time, we do have to keep in mind that our own Bloomberg News reporting just hours before Caroline Leavitt's statement was that U.S. officials had been preparing potential plans for a weekend strike, although those people familiar did caution us that the situation is incredibly fluid and that anything can happen. Now, we have to keep in mind here that these comments from Leavitt do appear to dial back the messaging that we had seen in recent days that a U.S. strike on Iran had appeared imminent, and now it appears that that is changing. We have a few different threads that we watch here, including which advisors President Trump is speaking to. For example, our reporting had indicated that his more hawkish tone came after speaking to more hawkish advisors, such as Senator Lindsey Graham, a Republican from South Carolina. Now, moving forward here, the White House has made clear that their ultimate objective is for Iran to abandon its nuclear ambitions. But we heard as recently as this morning from Iranian officials saying that they have no intentions of negotiating with the United States as long as Israel continues its airstrikes. And Matt and Katie, we have to keep in mind that our analysts at Bloomberg Economics say that Iran actually has the ability to escalate this in 3 ways. One would be targeting energy infrastructure. The second would, as you well know, be closing the Strait of Hormuz. Right. But the third would be targeting U.S. assets in the region. So no doubt that is something that this White House is contending with.
Well, I want to talk about how much sway some of these European nations have in this conversation, because we know the Iranian foreign minister is meeting his counterparts from the UK, from France, from Germany in Geneva right now. What do we know about those conversations?
Definitely. And we know that European allies are urging the United States to make sure that they stay on the same track when it does come to diplomatic talks. But it's also interesting to hear who the White House is talking with. We know the U.S. is, of course, in very close contact with its Israeli counterparts. The press secretary yesterday said that Benjamin Netanyahu and President Trump have had frequent calls. But then also President Trump has had some calls from Russian President Vladimir Putin, for example. He had lunch the other day with Pakistan's army chief. These are, of course, strategic allies of Iran who have suggested that they could help mediate any conflict going forward, though at this point it really is unclear what sort of role they would be playing here. But of course, we're watching this on all levels unfold, as Secretary of State Marco Rubio, for example, does seem to be focusing in on those more European allies, while President Trump takes some calls from others.
All right, Tyler, thanks so much for joining us. Bloomberg's Tyler Kendall there out of Washington, D.C. In terms of the markets, we've seen the S&P now turn considerably lower, off 13 points to 59.67. The NASDAQ down more than 0.5% as investors get defensive.
There you go, wiping out our weekly gains on the S&P 500. We know it could be a funky day with triple witching, but stay tuned throughout the U.S. day.
Ron Temple of Lazard, as well as Christian Mueller-Glissman of Goldman Sachs, join us on Monday. Have a fantastic weekend. Bloomberg Tech is up next.